Hey everyone, Simon here. I've just put together a quick video for you to highlight what I see as the main risks and opportunities facing equity investors and traders in the stock market this year, 2020. I promise there'll be no vision-related puns in this presentation, as tempting as it may be. This opening slide here, we've got a picture of Jerome Powell, Chairman of the Federal Reserve. We've obviously got Trump and Xi here negotiating a trade deal, and we've got potentially a debt bomb about to go off as well. And these are just three of the things that I think are likely to have an impact on markets going forward. So without further ado, let's dive right in. So first of all, welcome to 2020. Looking at the equity markets, the trend is up, up, up. Okay, really and truly, markets have been phenomenally strong since September 2019. Even the smallest dips in the stock market are being bought aggressively. Money is literally pouring into a handful of stocks, and that is mostly the so-called MAFANG stocks. That's Microsoft, Apple, Facebook, Amazon, Netflix, and Google. Although, to be honest with you, Netflix isn't getting a lot of new money, and Amazon is kind of lagging. So we've got a couple of consumer discretionary stocks there, maybe just sending a little warning to the broader market. But certainly stocks like Apple, Google, Facebook, and Microsoft are just on fire. But it is a fairly small number of stocks at the moment that are really leading the charge. Most of the major indices are holding their 8-period exponential moving averages, whether you're looking at the S&P 500, the Nasdaq, the Dow, even the Russell 2000, they're holding their 8-period EMAs, exponential moving averages, which is indicative of very strong uptrends. We saw some big upside breakouts on the S&P 500, the Nasdaq, and the Dow last year. They've all eclipsed all-time highs and have really surged on beyond those levels, which indeed is very bullish price action, and I think has left a lot of people in the market chasing. Bond yields are so low that stocks are the only game in town. I mean, who wants to invest in bonds yielding 1.7%, right? It doesn't really meet too many people's returns expectations. Even some of the most conservative investors in the world, such as pension funds and insurance companies, are not finding those returns particularly exciting, which again has seen a lot of professional money find its way into the equity market. The Powell put is firmly in place. Central banks certainly have our back, and we'll talk a lot more about central banks in the next few minutes. So with that as a backdrop, what is not to love about the stock market? Well, look, it's not all universally good news. So if ever you do feel swept up by bullishness, there are a few things I'd like you to consider. Okay, geopolitical risks are high. We've got a flare-up in the Middle East again. We had the drone attack on Saudi oil production facilities late last year, and we've had the recent tensions with Iran. We've still got political unrest in Hong Kong, although that's sort of not making the headlines anymore. China, Latin America, there are potential little flash spots around the world. Markets hate uncertainty, and whenever you get a flare-up in uncertainty, it tends to cause a bit of a sell-off in markets. Global growth is weak. The slowdown in China and Asia continues. There is a lot more debt in the global economy now. It's estimated to be at around $250 trillion than before the onset of the last recession, where global debt levels were about 148 trillion. All right, so the world has really piled on a ton of debt in the last decade. And there is a lot more consumer debt in the US now at approximately $16 trillion than before the last recession, where it was at about 13 trillion. So you might look at that figure and think, well, it's only an extra $1 trillion. What does that really matter? And look, it's a fair question. I think the human brain is just not very good at processing numbers as large as 1 trillion. And just final point, a large part of the bull thesis at the moment rests on the ability of global banks to continue to save us. They don't have much ammo left. Firstly, on this notion of what is $1 trillion, if you took $100 bills, these aren't dollar bills, these are $100 bills, and you stacked them end on end, $1 trillion would reach 631 miles into space, okay, which is 2.5 times higher than where the International Space Station sits. All right, so $1 trillion is real money. Some of you might be aware of the horrendous bushfires that have been sweeping through Australia. The damage bill last estimate was around about or even sub $1 billion. All right, some of the worst bushfires in Australia's history. You're talking about a damage bill of, let's call it $1 billion. $1 trillion is a billion. All right, so it's a big number. Just on central banks, this is a story that appeared in the FT just a couple of days ago. Central banks running low on ways to fight recession, warns Mark Carney. Mark Carney, of course, is the former Bank of England governor, so you'd think he'd probably know a thing or two about this. So the global economy is in a fairly delicate balancing act. Debt levels mean that there is reduced room for policy flexibility or policy error. And it means that it won't take much to sweep away the optimistic worldview that we're currently seeing. And that optimistic worldview really hinges on liquidity injections, such as the Fed repo action, the not QE4 that they're implementing, and negative interest rates. Okay, central banks have come to the rescue every single time, but their ability to keep doing so is sort of starting to be called into question. We've got the trade war, which is in a short-term truce. Now, there is the potential for this to flare up again. It looks as though phase one will get done probably next week. Phase two, they're probably a long way away from. I'm sure Trump would like to get the trade war tidied up ASAP, just to give him a bit more momentum into the 2020 elections. But like I said, phase two is a long way from being done, and that could start to creep into headlines again. And the Iranian conflict, which we've heard a lot about over the last week, it's been a big nothing burger for the markets so far. I say so far because it has been confirmed now that that Ukrainian 737 was shot down by an Iranian missile. And this raises a whole hope of questions. All right, how will Ukraine react to this news? How will Canada react? I think 1/3 of the passengers had Canadian passports. How many US citizens were on board? I mean, there are potentially a lot of questions that will come from this revelation. So I don't see this disappearing from the headlines immediately, even though markets have well and truly taken it in their stride so far. In fact, on the day after the Iranian missile strikes on the US base in Iraq, US equity markets hit their all-time high. Put your hand up if you thought an Iranian missile attack on a US base was what markets needed to get to a new all-time high. Just shows you how resilient markets are at the moment. I just thought this was interesting. You can see here the headline from the New York Times back in December of 97, impeachment vote in House delayed as Clinton launches Iraq airstrike, citing military need to move swiftly. Funny how history seems to repeat. So we should just talk quickly. Is war bearish for the stock market? Well, probably not as much as you might think. All right, this is a table that summarizes S&P 500 performance after Middle East tensions spiked. So these are Middle East tensions in particular, and you can see that really and truly, if you look 3 months later, 6 months later, 1 year later, the market has put in some pretty solid gains in nearly all of these scenarios. Really and truly, the ones that sort of stand out as negative are this one in 1973. But of course, in 1973, we had the OPEC crisis, we had global stagflation, and it was just a pretty horrible time for equity investors. So I think that that the cycle that the markets were in were far more relevant than that particular event. And really and truly, it just appears that war or conflict can have a short-term impact, but it's certainly not a reason to get super bearish on equities on a 6-month or longer view. The next slide looks at major global conflicts, and you can see, I mean, World War II had a massive fall, but markets bottomed 34 months before the end of World War II, and they were up 54% 12 months after they bottomed. Korean War, markets only fell 8%. Cuban Missile Crisis, markets fell 7%. Gulf War Mark I, markets fell 11%. However, they were up 34% 12 months after their low, which was 19 days before the end of the conflict. And in Gulf War Mark II, markets did drop 14% at the outset, but again, it bounced pretty hard on the way back. I want to spend a couple of minutes talking about the Fed repo action that's been in the news a fair bit lately. Just for a bit of history, in October 1999, the Nasdaq had already been in a bubble, according to many, for over a year. And yet from the 7th of October 1999 to its peak on the 10th of March 2000, the Nasdaq managed to rally an additional 76% in 6 months. During that time, the Fed was smothering the repo market with liquidity against risk of disruption from Y2K. You might remember that there was this fear that once the year 2000 rolled around, the world's computer systems were going to grind to a halt because they were using two-digit date codes for the year, and there was a worry that once the year rolled over from 99 to 00, computers were going to freeze up. Obviously that didn't happen, but there was a lot of concern about it at the time, a lot of uncertainty about it, and the Fed was pumping liquidity into the repo market to hedge against this. Now, the Fed performed similar actions when markets reopened after the 9/11 terrorist attacks in 2001. And the moves that the Fed has made since September 2019 are proportionately just as big. Now, the Fed insists that this is not QE, but whether it's QE or not, it is a big deal. Now, this chart just shows the effect these actions had on the Fed balance sheet. So this was Y2K, this was 9/11, and this is what we're seeing right now. It's basically a hockey stick move north in the Fed's balance sheet. This next chart focuses on liquidity the Fed is supplying to the repo market in particular, and you can see here this was in 2000, just before the onset of the tech wreck, but also this was the reason why the Fed was smothering the repo market with liquidity then was because of concern over Y2K. This was 9/11, Fed's injection of liquidity into the repo market. This was in 2008 during the GFC, the global financial crisis, and this is right now, well, the 22nd of December, but pretty current. That's about 3 weeks ago. So you can see that the Fed's current repo actions are significantly larger than anything they've ever undertaken. In absolute terms, it is the greatest support the Fed has ever provided to the repo markets. Now, at the moment, it's having an effect on the stock market that was similar to the effect it had on the Nasdaq back in 1999. Let's just have a quick look at a Nasdaq chart from back then. So here's a chart of the Nasdaq from the start of 1995 up until its peak in March 2000. And you can see that between 1995 and 1999, late 1999, the Nasdaq had put in a pretty impressive performance. Okay, it's gone from 400 to 2400, and people were already calling a bubble back around here. But that really was just preceded this final kind of gasp up where the Nasdaq gained almost 80% in the space of 6 months, in the last 6 months of that rally. Okay, and this was when the Fed's repo market activity started. So it really seemed to kickstart this enormous rally that we saw on the Nasdaq in the lead up to the big tech bubble. Okay, so the Fed matters, and so just to drive that point home a little bit further, this is a chart that shows in 2019 the S&P 500 rose 30%. But S&P 500 earnings rose only 0.3%. All right, so all of the gains in the market last calendar year were due to PE inflation, valuations getting more expensive. Now, PE inflation can go on for a while, but it can't go on forever. So the other thing that I think is worth bearing in mind is that we are not in, and we have not experienced a global recession in the last 11 years, not since 2008, 2009. However, central banks have been responding very strongly. In fact, they're behaving as if we are in a global recession. When you look at the negative interest rates, negative bonds, asset purchases by the three major central banks, being the Fed, the ECB, and the Bank of Japan, and you look at the Fed's recent repo actions. So the markets key investment thesis appears to be, no matter what, central banks will support and rescue me. This is if you're an equity investor. But the big question mark is, what will the response be when we do enter a global recession, given that they're already throwing tons of liquidity at markets? This is a chart that shows the Fed's balance sheet, and here you can see the hockey stick increase in size that we've seen very, very recently. This is all since September last year. So this was the balance sheet here post QE3. This is when we had quantitative tightening. This is when Powell told the market that balance sheet reduction was on autopilot, and this is the increase we've had since the repo actions have started. So it's very significant. So my outlook for the market is as follows. Short term, and I'm talking about basically from now to about 3 months out, the trend is up, but the market is looking stretched. Internals are bearish, and I think from these sorts of levels, a 5 to 7% correction could come at any time. Medium term, which I define as 3 to 6 months, equities have got a decent tailwind. Longer term, which is beyond 6 months in my terminology, I think some real caution is warranted. Now, these timeframes may be shorter than what you're used to. Bear in mind that I am a trader. I'm looking to take cash out of the market on a monthly basis. So my timeframes tend to be fairly short, but hopefully that gives you some perspective. So looking at the short-term prognosis, the trend is up, and we don't want to fight that. Okay, we want to be long because, well, I want to be long because I'm a trend follower. But there's a big but. The internals combined with sentiment and price action leave me feeling somewhat cautious. The put-call ratio is near all-time lows, and what that tells us is that everybody's long. Okay, and when everybody's long, if the market has a mishap, we find that there are no more buyers left. The market can hit a bit of an air pocket. Okay, the VIX is showing a lot of complacency. You know, when the VIX has the smell of fear about it, it'll rise to 20. The VIX is currently around 12 or 13. There is no fear at all in the market, really. The major indices are looking stretched and due for some mean reversion. And I'll show you what I mean by that on a chart in just a minute. But I think the key message here is we want to stay long, but remain hedged. So this chart shows the Nasdaq, and this is what I mean by the market looks stretched. You can see that whenever the market hits this upper red line, it tends to have a pullback. All right, so here had it, the market's pulled back. Here, market's pulled back. It just touched it there, we got a pullback. Same thing there. Didn't even get to the red line there, we only got to the second blue line, but that started something more major. We got to it here, we had a little pullback. We got to it here, we had a much bigger pullback. We got to it here, we had a pullback. And then what we've seen here is it's kind of riding along that red line, which is kind of similar to what it did back in January 2018. And then we ended up with a pretty sizable correction back then. But generally when a stock market index hits this upper red line, it puts a cap on the rally. Same sort of thing with the S&P 500. Okay, whenever we get to this red line at the top, it tends to put a cap in the rally. Sometimes you get a small correction, sometimes you get something rather more meaningful. But in each event, it does tend to at least put the brakes on. Here we had a little bit of a mean reversion. And then sometimes, as you see just here, it just rides along that upper red line. But when it does that, you tend to get a somewhat bigger correction. And this was back when all the short vol funds imploded, if you remember that, back in early 2018. I'm not saying the same thing is going to happen now, but we are on notice, okay? This is a warning. Also, sentiment is pretty bubbly as well at the moment. This is CNN's fear and greed index. My apologies. Now, usually when you get into the 90s, further gains in the stock market are pretty hard won. Okay, it tends to, again, just put a cap on things. So just shows that sentiment is really kind of got a little bit too exuberant. Now, on a 3 to 6 month view, equities have got some tailwinds. we've had monthly squeezes fire long in the S&P, the Nasdaq, and the Dow Jones. Now, a monthly squeeze is when or a squeeze is when you get a contraction in volatility. And when stocks break out of that contraction in volatility, stocks or indices, you tend to get a sustained move in the direction of that breakout. And I'll show you how this looks on a chart now. So this is a monthly chart of the Nasdaq. Each bar represents 1 month worth of trading. And this is just a custom indicator that I've programmed into Thinkorswim, which is the broker and one of the brokers and the charting platform that I use. And these cyan colored bars highlight a squeeze, which is a contraction in volatility. And what you can see is when you get a squeeze, it goes into a squeeze, and when it fires, so when the bars go from cyan to green, you tend to get a pretty decent move. Here we've got another squeeze, and again, you get a pretty decent move. That's not to say you can't get some meaningful pullbacks within that move, but generally you get a tailwind to the upside for on average another 6 to 8 months, and so we're basically 3.5 months into this squeeze, so we should have, I would think, at least another 3 to 6 months of upward trending prices. This is a chart of the S&P 500, again a monthly chart. You can see the last monthly squeeze here led to some pretty decent upside. We've had a monthly squeeze fire here, and we're getting some upside too. The dark green bars mean the trend is up, but the trend isn't that strong compared to the light green bars, which are showing a very strong uptrend. Again, this is just using a custom indicator that I've programmed in Thinkorswim. I call them magic bars. Okay, so those monthly squeezes should lead to a bit more momentum on a medium-term view. The Russell 2000 has broken out of its trading range to the upside and looks set to rejoin its all-time high. Now, the Russell 2000 has been a real laggard over the last year or so, and the fact that it's kind of joining the party with the Nasdaq and the S&P is good news for equities. 2019 saw record retail outflows from equities. I think it was about $109 billion flowed out of equities. So we've potentially got some cash on the sidelines. Now, these retail flows tend to be called quote unquote dumb money. That's not my terminology for it, but the theory is that this money will come back into the market as FOMO, or fear of missing out, kicks in. Buybacks are cancelling approximately $1.2 trillion worth of equity per annum versus US household savings of $1 trillion per annum. So let's talk about this a little bit further. Okay, according to TrimTabs, buybacks saw a float shrink in 2019 of $1.2 trillion. So $1.2 trillion worth of shares were cancelled. This is the 4th year of the past 5 that cash takeovers and buybacks have seen a float shrink of greater than $1 trillion. Now, bear in mind that US savings are about $1 trillion per annum. All right, so this is just supply and demand, folks. There's money is being accumulated that wants to find a home, and some of that money is going to find its way into the equity market through IRAs and 401ks and so forth. But that supply of equity is shrinking due to buybacks and cash takeovers. So people will talk about how valuations look stretched. I tell you what, it's not valuations that drive the market, particularly on a week-to-week, month-to-month view. It's supply and demand. The Fed continues to work the liquidity pump, as we've seen, and this is key, and really and truly, I think the Fed messaging and what the Fed does, and just as importantly, what the Fed says and what the Fed signals to the market will continue to be key drivers for equities this year. The other point is that at no point in this 11-year bull cycle has the market entered a speculative mania phase. Now, with Fed activity, that could be on the horizon. If we get a similar situation now as to what happened in the Nasdaq in 1999, markets could enter a legitimate melt-up. And in a melt-up scenario, everything could rally. Stocks, bonds, precious metals, everything could go up. Now, the term melt-up has been used quite a bit in the media over the last month or two. It's been in a lot of media headlines. We've heard Reuters and CNBC and Bloomberg all talk about the markets melting up. The fact is, they're misusing the term. We are nowhere near a melt up. This top chart here shows the Nasdaq in the last 2 years of its bull market from 1998 to 2000. It gained 416%. The Nasdaq over the last 2 years here has gained 61%. All right, so we're nowhere near a melt up. If we do enter one, really and truly, this is where you could see the S&P 500 rally to 4,000. Longer term, caution is warranted. Okay, we've got a deteriorating ISM, we've got a slowing global economy, debt levels are exploding while debt quality is deteriorating. So we've got roughly 250 trillion in global debt. That in and of itself isn't the problem, okay? Because we talk about global debt levels without talking about global asset levels, and obviously asset levels have increased in value as well. But it really comes down to the quality of that debt. That there's been a raft of triple B minus issuance, and if we do enter a tougher economy and a lot of that debt gets downgraded, there'll be no natural buyers for it, okay? Because the people who currently hold the debt, which is predominantly pension funds and institutions, are not allowed to hold junk rated debt. All right, so that's a potential problem, but for the longer term. But the debt levels do restrict policy tools, both fiscal and monetary. It's forecast the US budget deficit is going to be in excess of $1 trillion for the next 5 years. Do they really have the scope to be able to increase that significantly more, particularly if economy starts to weaken? And bond markets are clearly pretty cautious on the economic outlook as well. So a few things to keep an eye on. ISM is always worth keeping an eye on because it tends to be a leading indicator. And what we're seeing here is US ISM manufacturing in December was 47.2. That was the weakest print since June 2009. And what we're seeing here is a big spread, big divergence between what the S&P 500 is doing, which is the red line, and what the ISM is doing. All right. Typically, these two, they don't move in a one-for-one correlation, but they do tend to move together. And what has happened more recently is the S&P's sort of gone skyward, whilst the ISM has kind of fallen off a cliff, and it's fallen below 50, which means it's in contraction. All right, so that is something to keep an eye on. Either the ISM needs to recover and quickly, or the S&P could start to experience some weakness. Here's the similar chart expressed a bit differently. Here, the S&P and the ISM are standardized using a Z-score. And what this shows is that the spread between the S&P and the ISM is the highest since 1996. All right, so the divergence we're seeing is significant, and it does point to the S&P being overvalued compared to what the ISM is telling us. Just on the bond market, I mean, we had a lot of talk about the yield curve last year. The yield curve inverted and then it normalized and people were bearish and then they were bullish. But if we just look at 2-year Treasury yields, you can see that when we get a rally in 2-year yields and then a fall, you quite often get a recession, which is what this shaded area shows. Here we've got a rise and then a fall and a recession. We've had a rise, it peaks, and then a fall and a recession. Here we've had a rise, a peak, and a fall. Maybe there's another shaded area in our near future. But I think 2-year yields are another thing worth keeping an eye on. And labour markets. Now, labour markets are the laggiest of lagging indicators. And to be honest with you, the 4-week moving average of initial claims has been a yawn fest because it's just been on an inexorable climb lower really for the past decade. We did have a bit of a spike here, but if you look here, it looks as though it's starting to break out again, and this could get interesting if it continues to climb higher, because 4-week moving average of initial claims tends to have a pretty strong inverse correlation with the S&P. So if we do see initial claims continue to track higher, that will have a negative impact on the S&P as well. So it is a lagging indicator. It's one that's been pretty pointless to watch for the last few years, but I think it's one that was certainly one I'll be spending a little bit more attention watching going forward. A quick word on gold, because I do tend to get asked about it fairly often. The gold price tends to lead bond yields. Real yields are 10-year bond yields minus inflation. And what we see throughout history is that the gold price and real yields tend to track each other fairly closely, with gold generally leading by a couple of weeks. Now, the recent surge in gold prices implies a fall in real yields, which implies one of two things: either rising bond prices or a big surge in inflationary expectations, which doesn't seem likely right now. So this should be positive for bonds and the ETF TLT. Here's that relationship just tracked. What we've got is the gold price inverted. So gold is the blue line, and when the blue line falls, the gold price is increasing because it's inverted on the y-axis. And you can see again, these two data series tend to track each other fairly closely. Big spike in gold prices will probably lead to lower bond yields. So in conclusion, for 2020, for now, stay long but stay hedged. A pullback could see the S&P drop to around 3,000. That would see it back at around its 200-day moving average. It would keep it in an uptrend, but it would certainly shake out a few weak hands following the recent surge that we've had. However, I do think you want to buy the next dip, because we haven't entered a speculative mania phase at all during this 11-year cyclical bull market. Speculative mania phases is how bull markets usually end, and if we do enter a melt up at some point this year, you do want to be a part of that, particularly if you're a trader. And that sort of environment, we could see the S&P 500 quickly rise to 4,000. Now, if we do get a melt up, which I think is a distinct possibility, it probably won't end well. Okay, they never do. And for that reason, I think a good degree of caution is warranted in the second half, albeit we need to keep reviewing as new information comes to hand. Now, I've talked a fair bit about hedging. A lot of people literally don't know how to hedge. Okay, if you're just buying put options in the S&P every month, that's a dumb way of doing it. You're throwing money down the drain. It's a very expensive way of doing it. So I am putting together a video course on how to hedge. Late cycle markets become increasingly volatile. What do I mean by that? Well, in the last 12 months of its bull run to March 2000, the Nasdaq gained almost 160%, but it suffered 7 pullbacks during that time of more than 10%. So let's have a look at that on a chart. So here's the Nasdaq weekly chart this time. So starting in 1998, you can see a 25% pullback there. Now that was more to do with the Russian bond crisis and the collapse of long-term capital management, which kind of set up the low for the final rally into the tech boom. But during this period, even though we're in a strong bull market, we had a 13% pullback here, a 14% pullback here, another 14% pullback, an 11% pullback here. Then we had another 14% pullback, a 14% pullback, and a 13% pullback. All right, and the problem is when you enter a late cycle, you know you're on borrowed time, and you just never know whether it's just a 10% correction or the start of something more sinister. Okay, again, I don't know that too many people really believe that we're in the early stages of a sustainable bull market here, and we're in the early stages of the economic cycle. I think most people acknowledge that we're probably in the latter days of this economic cycle, and also the later stages of the stock market cycle. But if we do enter a really frothy period for the markets, you just never know when a pullback is just a correction. And let's face it, 10, 12, 14% corrections can be quite scary to live through, or whether it is kind of the end of the cycle. And the beauty of being hedged is you don't really care, because your downside is protected. And being hedged at the right time using the right instruments enables you to just be genuinely curious about the markets and watch what unfolds from a relatively unemotional standpoint, which is a very powerful place to be. So I'll give you some more information on this course as it comes to hand. Hopefully I'll get that up and running by the end of the month, but I'll keep you posted. If you've got any questions or comments, please leave them in the comments section below, and I'll be in touch soon. Thank you.